Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Well, we'll be talking big picture today. What's in store for commodities, for gold, for oil, for equities? My guest today is Scotty George, who's the Chief Investment Strategist at Alexander Capital. Scotty, great to have you.
Good to be back, Mike. Thanks.
All right, so let's go through the list. Big picture. What do you say? No, last time you and I spoke about gold, I think you said it wasn't ready. But I think recently you started accumulating a little bit down here.
Yeah, again, big picture is really where we're at. I think if you start looking at the earnings picture, more and more companies are deriving earnings not only from demand but from pricing power. And I've contacted you recently to let you know that while in the past I've been a little bit negative on some of the commodities and the potential for inflation, I think pricing power is now built into the market in the long term, and we're starting to nibble a little bit on tangible assets.
Now, is pricing power something we're seeing only here domestically in the United States, or because it's really not showing up in other countries? I mean, you still have deflationary pressures in Japan, you have China, economy slowing down. So is it something unique to here, and if so, can it be sustained?
Well, let's try to identify our terms. There is no inflation in the market right now specifically, nothing empirically. Anecdotally, on the other hand, if you look at the marketplace, airline tickets, the cost of fuel, the cost of tuition crossing...
Well, fuel's going down, though.
Fuel is a natural resource that's a depleting natural resource. The price varies based upon supply and demand. At some point, the supply is going to diminish and the demand is going to increase. So I think, again, you have to define your terms, your cyclicality. If you're looking short term, then clearly the energy complex is in a lot of trouble, and we haven't yet seen capital appreciation to a large degree in tangible assets. But what we try to do is measure where probability exists. And clearly in the cyclicals, the consumer brands, I wouldn't be going there right now. There's not enough demand in the marketplace. But we're starting to see elements of that demand and pricing power globally in the tangible assets, commodities, and including the energy complex.
Let's talk a little bit about sentiment, because as a trader, I've found that sentiment can really drive markets far beyond anything justified by the fundamentals. And if you look at something, gold, for instance, right now, sentiment, which is very, very bearish, and it's interesting because it comes against a backdrop of a lot of things that the gold bulls would have pointed to as being very bullish. You have, quantitative easing. Well, I guess ending here in the U.S., but Japan going full bore on that. You have the ECB going full bore on that. And you've had geopolitical factors that really haven't led to a big interest in gold. Isn't that an indication that sentiment is really, really negative right now?
Yes, but I would broaden that picture once again, because as you define it, there are a lot of elements geopolitically and exogenous to the market that are influencing negatively tangible assets. But here's where we take a much bigger term picture. Gold is not just a commodity. Gold is an element that has many connotations to it. Gold is a defensive play in stocks. Well, when stocks are moving, clearly the defense is going to be on and people are not going to want to buy gold. But what we're seeing, I think, is the beginning of pricing power in the market across the board, in commodities, in non-tangible assets. I think it's going to translate into the commodities market, and gold will be impacted positively as a result.
Well, it does make sense that if you look at the stock market, at equities, as sort of a barometer or a leading indicator, and we see the market averages making new historic highs right now, that at some point, if that holds true, that it is a good leading indicator, we should start to see some evidence in materials prices and industrial metals and that sort of thing, that things are picking up, that inflation that you're talking about is in effect starting to percolate.
Absolutely. The industrial averages are the numbers themselves are spectacular, but in the economy in general, it's rather underwhelming. And I think as activity picks up with infrastructure, technology, even in some of the consumer non-cyclicals and cyclical equities, that's when you'll start to see pricing power materialize. And again, I would urge all of your viewers to make sure that when they're talking about these issues, they define their timeline. If I'm on here today telling you that gold is going to rip-roaring price on the upside, that wouldn't be accurate. If what we're seeing, however, is a nibble of inflation, anecdotally, not necessarily empirically, then I think that's going to translate and migrate into some of these hard assets.
A lot of people were, I guess, fooled or surprised by the correction we saw in stocks. It was sharp but very rapid. It was over in a heartbeat and then back to new highs. There were a lot of people who were really bearish, who were calling for not just a large correction in magnitude terms, but ongoing. Were you kind of surprised at the rapidity of the bounce back, how quickly?
No, not at all. On the long term, the stock market is moving bottom left to top right. And we confirmed that at the end of 2008 and the beginning of 2009, at the end of the credit crisis and the housing crunch, when stocks were as cheap as you could get them. In that case, it was dart throwing. We started to see some broadening of the sector analysis, which ones were leading, which weren't. Tangible assets were not, cyclicals were, financials were rebounding. But the stock market got very, very expensive, Mike, and I thought we made a good call for our clients by taking profits in July and early summer. And when the market pulled back down, it simply gave us a new buying opportunity.
You make a very good point, and I think it's a point that's lost for most investors, is that the long-term trend of stocks, as you say, from the lower left to the top right, it rises, and I think that reflects basic growth in economies. Yes. Okay, but by the same, and you're talking about the behavior of equity prices. By the same token, if you talk about the behavior of commodities prices, don't you see periods of spikes where there's some kind of demand or supply shock, and then a long period of equilibrium, and this repeats and repeats? It's kind of like a sort of different behavior than stocks.
It is. Stocks are either moving bottom left to top right or top left to bottom right. You're either in a bull market or a bear market. Commodities move almost in a lateral period in which there are cycles of upness, cycles of downness. They are certainly much more responsive to longer term themes than they are to the kind of knee-jerk reactions that most people give to other sectors in the market.
So commodities really give us plenty of time to invest. The key thing with commodities, I think more so than stocks, I'm sure you would agree, is the patience factor.
Absolutely.
You gotta invest, or you have to buy when you have these periods, these lulls in the market, these pullbacks. But then you also have to be really patient.
Yes, you do. I think there's a method by which, certainly in our research, we can quantify these lulls, the duration of them, and when we see cyclical peaks, we're out, such as happened in the silver market several years ago. It's a more staccato pulse. Even though you're talking about these longer periods of accumulation, the prices of these equities move in a more staccato, quicker fashion than do the rest of the market. So you have to be nimble, and I think if you can quantify some of these cycles, you'll certainly make money in them.
All right, staccato, a little musical analogy in there. I like it. Scotty George, always a pleasure. Thanks very much.
Enjoy being with you.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.